year with a lot of exciting information here. I'm Nick Elder with Ironton Capital. I'm joined here by founder of Ironton Capital, Lon Welsh. Lon, how you doing today?
I'm fantastic. How are you? I apologize. I'm in a
Doing-
hotel room in Canada, so I'm sitting on a bed instead of in an office.
It's all right. It's all right. I think you sitting in Canada skiing is exactly what this presentation embodies. So I think it makes
Exactly.
sense. Yeah.
Well, thank you guys for taking the time to join us this evening, and I hope that you'll get some ideas on how to retire either a little bit earlier with a little bit more money, or maybe a little bit of both. And we're going to show you how to work smarter and not harder to get to your goals faster. And hopefully you'll need a couple million less than you initially thought to save up before you're ready to retire in the style that you'd hoped for. So let me ask, have you ever wondered what it would be like to wake up in the mornings with all the time that you need to do what you want rather than what you need to do because your investments are making returns on autopilot? So I'm going to share how you can get more diversified with your portfolio and or your self-directed IRA to work a little less. And we're going to go through the formula that we use with our clients so that you can calculate how you can retire a little bit faster. So if that sounds good, I know that's what a lot of you have been asking for. That's what we're going to go through today. So the problem, if you want to go to the next slide there,
Yep.
is a lot of investors are trying to make decisions based on what they hear on CNBC or the coffee shop, and they're not aware of all the advantages that are available to accredited investors, and they're trying to build their retirement the hard way. That's not your fault. So after putting in long hours at your career, you probably got a lot of family obligations. Very few people have got the time to dive deep into what are the best accredited investor investing options. And that's basically what you're hiring us to do, is do all that research for you. So as you listen to me, that's my goal, is to help you fix that problem and make decisions based on hard data and not gossip. So the more you know, hopefully the easier it'll be for you to make a shift. So what's passive investing? It's simply just a way to take yourself out of managing contractors, being the landlord, filtering out the renters and depositing the checks, or trying to get a check if they didn't pay. So it's based really on my 20 years of being an active real estate investor, and I wanted to spend more time skiing and golfing and a lot less time dealing with tenants. So we all know that knowledge is power, and I want that for you. I want to give you the power of when to know to act, and that's what we're going to talk about tonight. So notice, I'm going to show you some current case studies and some hard data today. None of it should be interpreted as a claim of income, implied or otherwise. A little love letter from our attorneys. You'll get some confidential information in our discussion. Investing in a fund involves risk. This presentation is not an offering for an investment opportunity. If you do find it interesting, contact Nick or I. We'll get you all the right legal documents that you and your financial team will need to thoroughly evaluate this, and we're delighted to share that with you. There's lots of forward-looking statements about where we think the market is going and on where our individual investments, how they're performing. Some of that's from us, some of it's from the companies, some of it's from market analysis. You'll want to do your own research, of course. And of course, there's a lot of company sourced information in all this. So that gets all of our regulatory requirements out of the way. So net, what that means is that your results are up to you, and I can't predict them. I'll certainly try to give you all the factual data that I can to help you, make a really good decision. So who's Ironton Capital? There's three of us on investment committee. Brent, Richard, and I, all of us have been involved in investment real estate for over 20 years. All of us have got a great track record of a high IRR, internal rate of investment, or internal rate of return. And we've got really slightly different slices on what we're the most experienced with. So Brent's a little bit more on the development side. Richard's done more for leading a private family office. He ran a $2 billion fund for a while. I've done more on the smaller development side, fix and flips, and then buying distressed office buildings, buying distressed apartment buildings, and renovating them. So we review, three of us really are full-time just in reviewing potential deals, flying out to visit the sponsors and figuring out which ones are the best ones for you. So the fastest and most predictable path to financial security and growth is passive investing. And if you can put your investments on autopilot, you're really on the way to true freedom, and then you can do what you want, hopefully more skiing or tennis or golf. So I think that's what we all want, is the freedom to experience life to the fullest while we're still healthy enough to be able to enjoy it. And that's what our training is really about. Consider for a moment how good you'll feel when you can stop trading hours for dollars and actually enjoy your travel, your charity work and your hobbies. So that's our mission today, is help you to be able to do that. So what are the challenges? There's a lot of bad information out there. It's hard to find the lucrative patterns. We all want to add more investments to our portfolio, but that it creates a burden of that. You've got to filter through the investments and try to keep tabs on all of them once you've actually bought them. So you end up with a much bigger portfolio with a lot more complication than you thought you're going to have, and it eats up a lot of time. And a lot of times your spouse, at least in my case, gets worried that, wow, we've got a lot of investments. What if something happens to you? How am I going to manage all this? So we've got a process that I think will be a little bit easier. Nick, do you want to talk about the different funds that we offer?
Yeah, absolutely. So we have, 3 core funds that, truly aligned with a lot of our investor strategies, risk appetites, and whether their need is equity growth or cash flow or a mix of both. So we achieve those outcomes by through a national diversified fund. So we're investing in a variety of projects, ground up construction, value add, where we're taking an existing asset, forcing appreciation to that asset through a renovation plan and increasing rents. Or we're doing a lot of local projects here in Denver, for example, some for sale townhome projects. But we diversify in 4 ways through NDF, and that's through the sponsors we invest through, the asset class. So you're looking at multifamily, residential, industrial warehouse, other types as well. Geography, so we're scattered across the United States. We typically select states in which there's high population growth, or it's a friendly business environment, friendly environment to be a real estate investor in. And then the 4th way is through the strategy. I've already alluded to those, but we're either going to be building something new from the ground up, or we're taking something that is existing, typically an existing asset that is neglected. Property management's been neglecting it. It's under market from a rent standpoint. There's clear advantage and opportunity to increase the value of that property through a business plan that would involve renovating those units. So that's our equity growth fund. So if your target is it's about a 4 to 6 year hold. If your target is growth, you're far from retirement, maybe you're 10, 15, 20 years, whatever stage in life that you are, you're far out from retirement, it's a great option for you. Great option if you have a self-directed IRA as well. Then we have an income fund. We have short-term income and medium-term income fund. One is direct correlation to the real estate market. The other one is more of a private credit. It's uncorrelated, and you'll see a lot of the uncorrelation slides that we have pertaining to that. The short-term income fund returns 8 to 9%, and the medium-term income fund returns 11 to 13%. Those both pay quarterly dividends with favorable liquidity, so not a 5 to 6 year lockup like the National Diversified Fund. Andrew's got a question. When diversified across states, do investors have to file taxes in all states? Thank you, Elon. No, we do the tax
For
filings.
the most part, we'll do all those for you. There might be some special considerations in California and New York. So definitely check with your CPA, but for the most part, we do most of that for you. It's a lot more efficient for us just to do it one time for 99 investors and have all of you guys do it separately.
Yep.
Great question.
Awesome. We'll go into some more of this information here, but let's go ahead.
Yeah, let's just go to page 19. So what got me started in real estate investing is when I got out of grad school, both my wife, who's a physician, and I had a mountain of student loans, and I got on a retirement calculator on Vanguard's website, and their rule of thumb is that whatever amount of money you were able to save up in your 401k in your brokerage account, you could spend about 4% of that per year, and then that money would last for your entire lifetime. So if you wanted to know, like if I had a $200,000 target that I wanted to have in retirement, you would take that 200 grand, divide it by 4%, and that would tell you how much money you had to save in your 401k or your brokerage account. And that turned out to be $5 million. And I did this and thought, my God, that is a lot of money for me to save up after tax. I don't know if I can do that. It just seemed like kind of a very large number. So if you just hit the advance button there, Nick, if you put half of your savings into our diversified real estate fund, and our target on that is around 16 to 20% a year. And if you put the other half into a traditional stock and bond fund, which is between 7 and 8%, then you're going to have a blended target return of 13%. So the way that the Vanguard or Fidelity calculator works is they take the target return, they back out 3% for inflation, and whatever is left over is the amount that you can take out each year. So the Vanguard site, they think you're going to make 7% because that's historically what the stock and bond fund has produced over the last 50 years. 7% minus 3% for inflation is 4% that you can safely take out each year. And then the amount that you take out will grow a little bit for inflation every year. So you'll keep up with inflation. Inflation won't eat away at your purchasing power. So if you have a more conservative portfolio, maybe you're like in a CD at your bank and you're making 5%, you'd be able to take out 2% per year. So 5% minus the inflation. If on the other hand, you can build a blended portfolio where you're getting 13%, then you'd be able to take the 13% target return minus your inflation estimate of 3, and you could safely take out 10% per year of your savings pool, and it would grow to keep up with inflation, and you'd be reliable for your income source. So in our case, if you have a $200,000 requirement and you can take out 10% per year, you only have to save $2 million to be able to get that $200,000 years of income. And that's my big insight that I had when I got out of grad school, saying this is going to be a whole lot more effective. So I read Rich Dad, Poor Dad, probably the only person on this call who's read that book. Started learning about real estate investing, and I bought my first rental property shortly after that because I didn't want to do it the hard way. So I'll pause there for a second. That's like a really important concept. If you guys have any questions about it, I'm happy to go through it again or answer any questions.
Well, we had a follow-on question to the one you just answered. Andrew's asking regarding how would that work doing it for us?
Oh, we file a tax return in all the states where we have operations, so somebody has to do it. So it could either be us as a fund, and that covers all the investors underneath us, or it could be you as an individual. So to the extent possible, we do all the paperwork for you.
No questions outside that.
Okay, great. So what I want to do is show you the impact of compound interest under a couple different scenarios. So in this case, I'm pretending that you guys are 25 years away from retirement. That's just sort of a convenient number. So if you look in the upper left-hand corner, let's look at, you've got a 4% savings account, and you've got $1 million today, and you're going to invest it for 25 years. You're not going to take any money out of the account. You're just going to let it compound and grow. How much money would you have after 25 years? So if you take a look in that upper left-hand corner, you can see that it will grow to $2.77 million. So $1 million today, in 25 years, you'll have 2.77 million. So it grows quite a bit. So the next question is, if I look at this on a today's dollars basis, that just means I take out the effect of inflation, because inflation is going to eat up most of that 4% return. And that's what the dashed line is on the bottom. So the $1 million of purchasing power that you have today will buy $1.3 million of purchasing power 25 years from now. So if you just leave all your savings in a 4% savings account and inflation is 3%, you really make very, very little progress over time because all of your interest is eaten up by inflation. Does that make sense?
Yep.
Okay. So let's take a look on the upper right-hand corner next. So this is your traditional stock and bond portfolio, which many of you guys have. I have too. This is part of what's in my IRA and 401k. You don't want to have everything in real estate, just something in real estate, something in stocks and bonds, and maybe a few other things. So historically, that's about 8.5% a year. So if you had $1 million today, invested it just in stocks and bonds, if you take a look at the blue line, you can see that's going to grow to $8.34 million. It's going to, grow eightfold over a 25-year span. And if we were to strip out the impact of inflation, that's the orange dashed line, you can see the purchasing power in today's dollars is going to grow from $1 million to $4 million over a 25-year period. So the stocks and bonds are phenomenal. In any given year, they certainly have got some volatility, but over the long haul, they've been fantastic. And that's why they'll still be a part of the portfolio for almost everybody on this call today. If you take a look in the lower left, this is called the medium-term income fund. This is what Nick was talking about a couple minutes ago. This I put in at 12%. It's going to be somewhere between 11 and 13% is what we'll be paying you. The more you invest, the more you get paid. Just like if you go to your bank and you take out a certificate of deposit, the more you invest in your CD, the higher the interest rate the bank pays. It's the exact same logic. So if you had $1 million today and you invested at 12%, the compounding over 25 years will grow to just over $19 million over a 25-year period. So if we strip out the impact of inflation, it's going to go from 1 million to 9.4 million. So some of you guys aren't 25 years away to retirement. Maybe you're 20 years away. So you can see where it says 20, instead of growing to 9 million after inflation, it'd be growing to 6.1 million after inflation. If you're 15 years away to retirement, you can see that it grows to 3.97 after inflation. So whichever time horizon you're working with, you can take a look at these graphs and get a sense of how your performance might look. So last but not least, NDF in the lower right-hand corner is our National Diversified Fund. So that's the long-term growth fund that Nick was talking about a minute or two ago. Our target on that is between 16 and 20% a year. So I put in 17 and said, what would that do? So if you had $1 million today, that would grow to 59 million over the course of 25 years. If we strip out the impact of inflation, it basically cuts it in half from 59 million to 30 million. So it's amazing how sensitive these things are. And if you could add just a couple more points to your rate of return over the long haul, it makes a huge difference. I wouldn't want any of you guys to put all of your money just into NDF. It could be part of your portfolio with some other things, but you want to diversify as much as you possibly can. So I'll pause for a second. That's a lot of information, and see what questions you might have.
Yeah, so another question here. If entering retirement, what different considerations are there?
So the main thing about it is that you need to make sure that part of your portfolio is liquid so that you can get access to it if you need it, because you probably don't have a W-2 job anymore. So one of the disadvantages of the National Diversified Fund is that the money is stuck for 4 to 6 years and it doesn't have any liquidity. So if you put money in it, you can't just pull it out on demand when you need it. As opposed to in the upper left-hand corner, your savings account, you're always going to have some money in savings, ideally about 6 months worth of living expenses. You always want to have some amount of money in the savings account so that if you've got something pop up, like I need a new set of snow tires or something like that, cash is just right there. You don't have to worry about it. Part of your cash could be in our short-term fund because it's really liquid. We need about a month to get the cash out. So it wouldn't be good if you had an emergency today, but if you've got something that's coming up in a couple months, the short-term fund is great. Stocks and bonds are also very liquid. You can always make the decision tomorrow to sell your Apple stock and you'll have the money in about 3 days from your brokerage account. So I think liquidity is part of it. And then usually for most people that I talk to, there's like a couple different phases of the investor's journey. When you're younger, most of the focus is on building up your assets to get to the target income you need for your retirement, and you're still working actively. So it's okay to be a little less liquid because you've got a job. It's okay to be a little bit more aggressive because you've got plenty of time to recover if you have a year that's not favorable in the stock market. So a little more aggressive. Once you get close to retirement age, most people are usually getting pretty close to where they've got the right amount of money saved up. And now it's just a question of how do I, invest the money well during my retirement. But most people become a little bit less excited about risk once the amount of money they've got is big enough. So when that gets to be you might be a little bit less in the National Diversified Fund and a little bit more in our income fund because they're so much more stable, predictable, and liquid. That's a long answer to a short question, and the answer precisely will be different for every one of you. And Nick and I love talking to people to try to give advice on that. We're not financial planners, but we'll try to guide you as well as we can.
Yeah, absolutely. We got 2 questions on. What about putting most of your money in MTI?
It's my single biggest investment by far. I love MTI because it's very predictable, and all of the chaos of the stock market all of the chaos of interest rates and what it does to real estate valuations has no impact on MTI. And I sleep very well at night knowing that every quarter I've got a big dividend check coming from MTI and I just don't have to worry about it. So
Yeah.
yes, for many of you, MTI is going to be a cornerstone part of your overall plan.
Yeah. One thing to add to that, we do have a reinvestment offering as well. So if you don't need the income, but you still want something that's uncorrelated, you have the ability to reinvest your dividends and compound at the 12% rate. Another question that rolled in here, if it's two more questions. If it's a 4 to 6 year fund referencing the National Diversified Fund, what are you transitioning to in 6 years?
So for a lot of people, if you are still a ways away from retirement, you might take the proceeds from Fund 12, which is the one that we're working on right now. And by then, we'll probably be working on Fund 18 and Fund 19. You might just roll the proceeds into the next National Diversified Fund. Or some of you might choose, maybe I'll put half into the NDF 19, I'll put half in the stock and bond market. Or, we'll talk to you when you get to that point and help you make a good decision.
And then what in the world could go wrong that could hurt an investment in MTI?
I don't think there's anything that could lead to like a capital loss that we can realistically identify. I think the biggest risk is legislative, where maybe we're in Minnesota and they decide that it's no longer permitted for third parties to buy medical receivables from hospitals and physicians. So if that were the case, the portfolio we've currently got in Minnesota, we would just get paid off from that. We couldn't buy any new ones there. So we operate in about 10 different states. We would have to just allocate the money into other states. That's not a lot of risk, but I think legislative risk is the biggest thing. We intentionally picked a structure where our counterparty that's paying us is the insurance company. So it's, Geico or State Farm or Allstate. We're not collecting from consumers. So I think that really manages our legislative risk quite a bit.
Another good question here. Does the National Diversified Fund take advantage of the aggressive depreciation available in year one, possibly offset capital gains after real estate sale?
Yeah, absolutely. So for the long-term fund, we have two share classes. One share class gets a better preferred return, but it gets none of the tax losses. So if you're investing, for example, in your IRA, you're not allowed to use tax losses. So that would be a really good choice for you. The other share class gets a smaller preferred return, but it takes all of the losses we can generate, and we are very aggressive about accelerating depreciation as much as we can. So the ideal client for that is if you're currently an active landlord and you're a little frustrated with the tenants and you decide to sell your property, you're going to probably have a capital gains tax and some depreciation recapture to pay to the IRS. So one way to deal with that is you could do a 1031 exchange, buy another rental property, and if you follow all the procedure, you can legally defer the payment of the taxes until later. Another method is you can invest in our National Diversified Fund. We can't do a 1031 exchange, but what we can do is give you a lot of depreciation write-off, and you can use that to offset the capital gains and the depreciation recapture. You'll of course want to check with your CPA for your unique situation, but everything we've seen so far with our investors, that works out pretty well. If that's your case, reach out to Nick and I, and if you can tell us like 6 or 7 basic facts about the rental that you're about to sell, we can model out for you and your family what it means for you wealth accumulation wise if you were to do a 1031, keep the rental, buy another rental with a 1031 exchange, or invest with us. We can show you all the pros and cons. We do that multiple times a week.
Yep.
Great questions. Wow.
Yep. That's everything. Oh, we got one more that rolled in.
Yeah.
So for MTI, dividends are generated by the accounts receivables. When you want to get some or all of your investment principal out, how is that money generated?
For
Is my
MTI?
understanding correct? Yeah.
Yeah. So the typical lifespan of one of those receivables is between 12 and 18 months. So you can't get any liquidity for the medium-term fund for the first year. And after that, we ask for 3 months notice when you need cash out. So what's happening is as you're into the life of this fund, every quarter we're getting the payment from Geico or Allstate on some of the claims that are settling out, and we've got cash coming back. And we take a look at how many investors need to have cash. We send them their check back, and whatever's left over, we go buy the next batch of receivables that'll mature like in a year to a year and a half. So that's why we need a little bit of notice, just so we can time when we get cash in and when we can pay you?
Good question.
Great question. So this quote is attributed to Einstein, and the compound interest is the eighth wonder of the world. If you understand it, you earn it. If you don't, you pay it. It's one of my favorite Einstein quotes of all time.
Hey, Lon, we had another question trickle in here. So Brent's saying, I've been in a couple of investments where the sponsor got caught in a rising interest rate environment. How does Ironton Capital structure its debt on various properties?
So it's a really great time to be a buyer of apartments right now. Prices nationally have dropped about 20 to 25% from the peak in 2022. And if you're buying an apartment complex now, you're buying it under the assumption of today's very high interest rates, today's high insurance rates and property taxes, and with the labor costs being so high, all those things have increased quite a bit over the last 5 years. So since you're buying it to get to a certain amount of cash flow with all of those headwinds from assumptions, if we see any relief on any of those variables, that has a really favorable impact on valuation. Once a month, Nick and I will do a national real estate trends webinar, and we explore this topic actually in quite a lot of depth. And I've actually got like 15 slides where we talk about all the components that go into that. So to kind of keep us on track for tonight's schedule, I won't go into any more detail than that. But if you'd like to explore it, I would love to talk to you about that during our trends webinar, because it's a big focus point of that class.
Yep. Yep. Question with the drop overall in prices and in value, how are the earlier NDF funds doing?
Some of the investments we made in earlier funds have definitely suffered as a result of that. So fortunately, all of them were diversified enough. We so far have always had one or two investments per fund that worked out really well. We've had one or two stinkers, usually because of this rising interest rate environment, and then most of the rest kind of came in on plan. But yeah, we're certainly not immune. Not every investment works out. That's why diversification is so important. Just like the stock market, it'd be great if we could all pick NVIDIA and Apple before they went through their huge rises, but we're not that good all the time.
Do you want me to go on to the next slide, Lon, or you want to stay here?
Yeah, let's go ahead and do that. So the next chart here just shows you like a 10-year view. And on the left-hand side, let's imagine that you've got $184,000 of equity in a rental property. So maybe it's worth 300. You've got 120 of debt. You've got 180 of equity. And we would do this math for you and find out what return on equity are you currently generating with your rental property from the cash flow that you generate after your mortgage payment, if any, and the appreciation. So this is a real live example here, actually. So for this investor, they were earning about a 9% return on the rental. So if you remember, the long-term average for the stock and bond market is about 8.5. So this rental was doing better than the stock and bond market, which was nice. So we estimated that for this investor, if they just held on to this rental for the next 10 years, their 184 grand of equity would grow to about 430,000. It would more than double. So a question that this investor had for us is that, well, we're frustrated with being a landlord. We bought this property for like $80,000 in 2012. It's gone from $80,000 to $300,000. We wanted to maybe just sell it and pay the gains. What would happen? So that's in the left-hand column. So what happens is that you have 184,000 of equity. You'd have some sales costs and commissions and title fees, and you'd have some capital gain tax. This is the net tax. We estimated how much write-off we'd be able to generate for this investor to offset part of the capital gains bill. So the 15,000 is just what was left over. So the amount available actually to invest is just under $150,000. And the target for Fund 8 was 17%. Fund 12 that we're working on now is a little less than that, 16, pretty close. So if you take that 149,000 and grow it at 17% a year, you can see by year 10, it's growing to 720,000. So this is part of the analysis we could do for you if you're an active landlord. So it's really counterintuitive. You'd think that I just need to hold on to this rental property until I die, and that's the best answer. When in reality, the best answer is to sell it, pay a little bit of capital gains tax, embrace passive investing and you wind up with almost twice as much money. You think, wow, that's so much different than what I was taught when I bought this rental property. What's changed? Well, the biggest thing that's really changed is that the Denver market in particular, and real estate in general in America, has appreciated so much, so fast, that there's a lot of us that bought in 2008, 2010, 2014. And over the last 12 to 15 years, those properties have tripled in value. And since we all locked in mortgage rates at super low percentage rates in, like, say, 2021, we've been able to pay off those mortgages pretty quick. So most of the people I talk to are sitting on a property with a huge amount of equity. But meanwhile, the rents, well, they've gone up. The rents haven't gone up nearly as fast as the property values. So you've got this scissor effect where the blades are getting further apart each year, where the property value goes up and up and up. The equity really skyrockets, but the rents are only going up at a much more modest pace. And there's this gap that gets bigger every year. And that's why the return on investment for most landlords is somewhere like around 8 or 10%. And if that's the case, usually selling and reinvesting with us will actually, you'll make more money and have less work. It's really amazing.
Yep. Comment here. Rent's dropping now here in Denver. Expenses are soaring. Yes, that is the case.
It's
Been
been
the
a
case.
frustrating couple of years. I had over 140 rentals at one point, and I'm down to a little over a dozen, and I'm going to try to sell those over the next year or two. I'm done.
Yeah. Something that may be just worth highlighting there. Lon, first of all, do you want me to go to the next slide?
Sure. Well, actually, why don't we tie out this thought before we go to correlation?
Perfect. Something I'm just going to mention here, Andrew, I'll do a quick spiel on here. The reason why rents have dropped so significantly, we had some of the highest supply coming to the market in Denver and some other large cities, driven from the increase in activity from the low interest rate years. All that supply got delivered at around the same time, 2023, 2024. Now what we're seeing is a huge drop overall in deliveries to be expected over the next 8 quarters to 3 years. So I would anticipate nationwide we'll see rent growth normalize more in line with inflation. I don't expect that we'll see the 10-15% drop continue on for another couple years, just given the supply demand economics that we've been seeing, how those will be trending over the next couple of years.
And this actually is another topic that we do in our monthly national real estate trends, where we talk about supply and demand trends, what it means for rents and vacancy, and what's likely to happen next. So if you're interested in that, we'd love to have you join Nick and I, and we talk about this every month.
Yep.
So I want to talk a little bit about portfolio construction. So this is a picture of Harry Markowitz. He won the Nobel Prize in economics for developing modern portfolio theory. And he really gave us the cornerstones for most of modern finance, how you build a portfolio and how you think about risk. And the important insight that he had, and that's what I want to talk about over the next couple of slides, is that the correlation between the assets does a lot to describe the overall risk of the portfolio and the returns that you earn. So let me try to help you illustrate that. Usually, we think about risk and return as being highly related or correlated. So the more risky the asset, the more returns we'd expect to get. So as an example, if you've got money sitting in your savings account at Wells Fargo, you're probably making 0.1% interest. So it's super low return, and there's absolutely no volatility on your savings account. I mean, there's never anything unpredictable about that. Around the middle of the scale might be the stock market. So maybe the stock market long-term return is like around 10%. So it's a very good return, but there's also a lot of volatility. About 1 year out of 5, we expect the stock market to lose money. And 4 years out of 5, we expect the market to do well. We've been on a great streak recently for the stock market, which makes me think we probably have a bear market coming sooner or later here. Something that'd be very high risk and very high return might be investing in a startup company. So you're not sure if it's going to work or not, but if it does work, it tends to be extremely high return. Or just picking like one stock or one rental property. Usually those will be higher return and higher risk. So what Markowitz, the Nobel Prize winner, thought is that if you could add some non-correlated assets to your portfolio, you could reduce the risk and not give up any return. And that's something that we're all pretty interested in. I'm going to explain how that correlation works in a minute. So alternatively, you might decide that you're comfortable with a given amount of risk because you're younger and you got plenty of time to recover. So risk tolerance is high for you. If you could build a portfolio with assets that were not correlated, you could keep your risk constant, but increase your returns without taking on additional risk. So let's talk a little bit more about how that actually works. What's correlation? It's just a statistic that measures the degree that two things move in relation to one another. So a positive one shows they're perfectly synchronized. A negative one is they're perfectly out of synchrony. And a zero would be there's just no relationship between these two things at all. So let's go to the next slide and kind of explore that. So these two securities are perfectly correlated. So if one goes up, the other goes up. If one goes down, the other one goes down. So there's very few things in life that reflect that. But two numbers that are always perfectly correlated is the number of pennies in a dollar. It's always 100 to 1. So if you have $2 or $100 or any number of dollars, if you multiply it by 100, you're always going to get the number of pennies. So if you had a chart of that and said, what's the correlation between the two? You'd find they are 1.0. They are perfectly correlated. So something that's negatively correlated would be on the next slide. So every time this asset goes up, the other asset goes down and vice versa. So they're said to be negatively correlated. So let's go to the next one. Well, you want to talk a little bit about MTI, and then I'll talk about how MTI fits into this?
Yeah, absolutely. So we touched on this a little bit, but to look at this from a more of an executive summary. So what we're doing essentially is we're providing financing solutions through our medium-term income fund to medical service providers. Those can be hospitals, physician clinics who are treating those who've been injured in car accidents. And so, given the nature of the accident, given the nature of the treatment, those bills get billed to the auto insurer. The auto insurers, they go back and forth with the attorney and whatnot to determine who is at fault, which insurer. Is it going to be Geico? Is it going to be State Farm? Is it going to be Allstate? Which one is going to ultimately settle on this claim and pay out, and then also cover the medical expenses? So, as you can imagine, there's a ton of back and forth. These aren't overnight solutions. They can take, as Lon mentioned, they can take 12 to 18 months. In the meantime, the physicians, they've treated these patients essentially on contingency, waiting for these payments to settle so they can ultimately get paid, pay their staff, keep the lights on. That's what they need to do. So they come into a cash situation where maybe there's a shortage as they're waiting for these stack of receivables and claims to ultimately pay out. And so that's where we step in. So we come in, we will either acquire the receivables at about a 25 to 35 cents on the dollar with a typical collection rate of 60 to 80 cents. We either buy them outright, and then in addition, we take over the paperwork burden as well so that the office doesn't have to spend all this time, energy, going back and forth, fixing some of the errors they may have submitted in the first round of paperwork. So we take over the paperwork process, and then by acquiring the receivables, we'll also collect on behalf of the claim, and then that's what generates the returns for our investors. If not that, then we'll issue a line of credit, typically at about 25 to 35 cents, collateralized by the portfolio of medical receivables. In doing so, we get interest income, and then when the claims ultimately settle, there's a payout split between us and the clinic. So that's what generates. That's the premise. That's the asset class that we're investing here. So you can imagine people continue to get injured in car accidents. There's a continued need for this financing solution. So it really doesn't matter if interest rates or if the Fed Reserve, increases interest rates to the nature they did in 2022 and through 2023. Doesn't matter if they decrease interest rates. Doesn't matter if there's a bubble in artificial intelligence. It really is completely irrelevant to the performance of the medium-term income fund here, and that's what makes this such a special fund in that regard. So overall, the fund returns 11 to 13% a year, which is largely dependent on your assets under management with Ironton Capital. Pays quarterly. There's a 1-year lockup, and then redemption's available with a 3-month notice. And the fund's open all the way until June 2031. So anything I missed there, Lon?
Nope, that's fantastic. Any questions we should address?
Yeah, what are the risks? You mentioned legislative risks. Can you think of anything else? Anything else
That's
on
the
that?
biggest one. The risk is that you've got like a fraudulent claim. So we
Yeah.
expect that 2% ish or so of these are going to be the lady who says she's got a neck injury from rear-ending a car, and the judge says, "Gosh, weren't you in here last week in an accident? We're not going to pay this claim." So we have an allowance built in for those sorts of claims. We can go back to the physician and say, like, that claim's not any good. You have to replace it. So that's really the only other risk, and that's built into the model. There's always
Yep.
a little bit of fraud and everything, it seems like.
And then another question, who is the we? Is it Ironton or is there a parent or larger corporation, and how do
Yes, there's a co-general partner. Their name is PFD. So their responsibility is they build the relationships with the clinics and physicians. They underwrite the receivables and they go through the collections process from the insurance company. Our responsibility is we talk to people like you about it to raise money. We've raised what, 32 million, 34 million so far?
between both I believe we're at 40 million now.
So we raise money for the fund. We handle all the investor Q&A. We organize the tax returns and the filings in the different states. We have an independent auditing and accounting firm audit our results each year, and we're happy to share the results of that audit with you. So we do all of that. So we kind of divide the labor between the two.
Yep. Good question.
Yeah. So what I want to do now is take a look at how the medium-term income fund compares to the stock market. So if you take a look at the left-hand side, you could see there's a blue line, and this is the medium-term fund. And I think I popped it in there, assuming that you were getting a 12% annual return. So if you invested 20 years ago and put in $100, your MTI was the blue line. It would have grown to about $900 over the course of 20 years. If you take a look at the orange line, you got the Bronco colors here, which is great. A $100 investment in the stock market in 2005 grew to a little over $520 over that same time period. So both the stock market and MTI had a phenomenal 20-year period. So let's take a look at what the quarterly returns are like, and that's on the right-hand side. So you can see the stock market is the orange line. It's bouncing up and down every single quarter. There's really no pattern to it, but mostly it's up. But when it's down a lot. If you take a look at the blue line on the right-hand side, you can see it's just a very boring, steady 3% every quarter, no surprises. So then what we do is we apply the statistical calculation, and you could do this in Excel. It's one of the functions that's built into Excel. What's the correlation between these quarterly returns from the stock market and the quarterly returns that we got every period from MTI? And the answer is 0.01. So basically there's no correlation between the stock market's return and the MTI return. The stock market could be high, it could be low, it could be flat. It doesn't have any impact whatsoever on what MTI returns to you. And the theory that the Nobel Prize winner came up with is if we could have some things in our portfolio that are not correlated, we can increase the overall return and manage the risk. And MTI is just a fantastic way to do that. And this is why I personally have so much in MTI, because it's a counterweight to real estate, which is very interest rate sensitive. And I do have a fair amount in stocks and bonds as well. So I'll pause there for a second, just because that's a lot of information. Let's see if you have any questions.
And we got two questions here, or excuse me, three questions. So no individual tax filings in DF question.
No.
Yep.
Check with your CPA. You shouldn't have to, but double check. But my understanding is that you shouldn't.
Yep. Then question here, I'm going to try my best to articulate this. What happens when a real estate buy in a MFD fund, maybe they mean NDF fund, goes upside down? Bought hit, market falls. What is ongoing risk mitigation to maintain 1 to 6%?
Oh, for the 16%? Our expectation is if
16, sorry.
Okay. So
Yeah.
our goal with this, of the National Diversified Fund, is to try to have about 40 different commercial real estate assets in about 10 different states, to have some in multifamily, some in industrial warehouse, some in hospitality, some are new construction, some are heavy renovation, with a whole bunch of different sponsors or general partners that we're working with. And our expectation is that across 40 of them, 1 or 2 are going to work out really well. 1 or 2 are going to be a disaster. and most of them are going to come in mostly on plan. It just sort of averages out. Great question.
Yep. And so MTI ends in 2031. Why not, or why would it not continue?
It probably will. So the sponsor that we work with has done a number of these funds in the past. So they raise money for a while, and then when they've finished raising for that one, they just launch the next fund. So I imagine that'll be the case here as well.
And what about competition, MTI from others? Are there any barriers to entry?
I think the biggest thing here is that when you advance money against a receivable, that's called factoring. So there's lots of banks that do factoring. It's actually a very common financial loan product. What the sponsor has really figured out is they take over all the paperwork and administrative burden for these small claims. So the hospital and the doctor doesn't have to deal with it anymore. They just get cash flow today. So that really what we're selling is administrative convenience, and the factoring or the cash flow is sort of the icing on the cake. It's really easy to copy the factoring. Like any bank that wants to do that could learn how to do it really easily. It's very hard to replicate the process of dealing with the insurance company. So that's what creates the barrier. Great question.
And then any threat to MTI from the continued upheaval in healthcare and Medicare?
I don't think so, because it's mostly car accident claims that we're underwriting, and that's usually, State Farm and Allstate. That's our counterparty, not the government.
Yeah, and ultimately, it's the auto insurers that are paying out on the claim. So you probably looked at your auto policy and you see that you're covered, any bodily injury is covered up to a certain amount. Those claims get billed to the auto insurer. It's not getting billed to your health insurance company. So
Yep.
the upheaval in healthcare, Medicare, it's maybe there's some part to play in the grand scheme of things, but in reality, as Lon mentioned, we're not interfacing and dependent on payments coming from them. It's dependent on the auto insurer's ability to pay out on the claim.
Exactly. Great questions, guys. Let's skip this and go to the next one. I'll have to skip some slides so we can finish on time. So this chart is exactly the same thing as what I just showed you, but instead of looking at MTI versus the stock market, I want to look at the bond market, because the bond market's much more stable. So if you take a look again on the left-hand side, let's look at 20 years. We put $100 into MTI 20 years ago. It grows to $900. So we already talked about that on the last slide. The orange line in this case is the bond market. So if you put $100 in the bond market, it would have grown to 178. Pretty good, like it almost doubled, which is pretty great. And if you take a look on the right-hand side, you can see the blue line again is the stable returns that we get from MTI, and the bouncing orange line is the bond market. So if you were to flip back and forth between the stock, don't feel like you have to do this now, between the stock returns quarterly and the bond returns, you'll find the bond returns are like a small fraction. The volatility is just so much less. But once again, if you run the correlation between the quarterly returns of MTI versus the quarterly returns of the bond market all in, you find there's no correlation between them. It's exactly 0.00. So what this tells us is that MTI is a good way to add extra return to your portfolio without adding any additional risk. And that's what this whole Nobel Prize winning theory was all about. I'll just pause for a second, see if you have any questions on that.
I just had some question I've been answering in the chat here. And how long have you been in business? How long in the medium term income fund? Do you want to answer those two questions, Lon?
Yeah. So on the long-term fund, the team at the general partner that does it, they're close to 20 years. They've been running the strategy. About the first 13 or so years, they were working for a private equity fund, and they all sort of self-discovered that, we could go out on our own and do this and not share all the profits with the guy that owns it. So they went out on their own. I think it's been 7 years now. And we've been working with them for about 3 years. For the short-term fund, that's Indicate Capital as our partner, a similar relationship where we raise cash and do all the communication with the investors. They vet which projects they invest in. I've known those guys for a long time, well over a decade. Their first fund, I think, was 12 years ago, Cost Fund 1. And the current fund that we are collaborating with, I think it's been around for 7 years, so quite a while.
And then here's a question, Lon, regarding MTI. Very convenient for the docs, for the medical community. May AI impact the process?
Yeah, I don't think AI is going to have a whole ton of impact on it that I can see so far, but we'll definitely keep you apprised of that if we see any new developments on that. Great question.
I may speculate. I could see where it might assist quite a bit in the documentation process. If you could run historical data right through AI and determine, how can I, maybe submit this paperwork so that it accelerates the time frame of getting to a solution. That might be where it can be beneficial. The other thing is, you know, it was a very important and very real thing to abide by. So those things are always a consideration as well. From a financing standpoint, I don't really understand how AI would replace the financing aspect of it. I think that's going to be a continued problem, and whether or not AI can solve that without the need of our fund. I'm skeptical of that. If I trade my real estate for a piece of NDF, what is it that I own? Do I trade my real property for a percentage of the LLC? What do I have for my heirs in the end?
Well, we're going to invest in about 40 different commercial properties in around 10 different states. So if you provide 1% of the equity of the fund, you'd have about a 1% ownership of all these different assets. So what'll happen is you're going to hold this either in your own name or in your trust or an LLC. Your financial team will figure out for you what's the best. And let's imagine as part of your estate process that you're going to leave your trust to the estate, and your kids are going to inherit the estate and everything in it, like your car, your house, and then your position that you have in the National Diversified Fund. So whatever your estate attorneys figured out is the best plan will help you accomplish that.
And how do NDFs differ from a real estate investment trust?
Great question. So there's a couple different forms of doing this. One's called a REIT, a real estate investment trust. So there's a couple great things about REITs. First of all, many of them are publicly traded, so you can buy into. So just as a quick step back, a REIT is a vessel, it's a basket, and you can fill it with whatever you want. So you could buy all apartment buildings that are deluxe. You could buy industrial properties that focus on refrigerated warehouses. You could buy just hotels that are branded Marriott. There's a REIT for just about anything you could possibly dream up. So what's great about REITs is that they get you exposure to commercial real estate, specific about the sector or the geography or whatever is of interest to you. And a lot of REITs are traded on an exchange. So there's price discovery almost every day. So you could buy a REIT tomorrow morning and oops, shoot, can you still hear me?
Yeah, you're fading out a little bit.
All right. Am I back? Can you guys hear me?
Yeah, you're good.
Let's wait a second here. Looks like, shoot.
I can answer some more of this as well. So another key thing is the National Diversified Fund. Lon, apologies if you already said
All
this.
right. I think I'm back. I'm going to wait
good,
1
Lon.
minute to see if I've got a stable connection here.
Can you hear us? Can you hear me?
I apologize. I am in the middle of nowhere, Canada. It is snowing nonstop, and the internet has not been all that reliable. Unfortunately, this lodge where I'm staying has a backup generator, so at least I have light and power. Nick, can you hear me okay now?
Yeah, you're good.
Fantastic. So the REIT, one of the things about it is most of them are traded on an exchange. So you could buy one tomorrow morning, and if a month from now you decide you want to sell it, you'll be able to sell it like you could sell a share of Apple stock, and the price might have changed a little bit, so you'd have a loss or a gain, but you can figure out what that gain is right away. So it's liquid. Another great thing about a REIT is that they are required, just by law, that at least 90% of the cash flow generated from the property must be distributed to the shareholders. So they tend to be cash flow oriented. They're not allowed to retain any of it. So what this means is they have to buy assets in really good condition, not things that require renovation, because they're not allowed to withhold any cash to pay for the renovation. They have to have an asset that's beautiful and great and throwing out cash when they buy it. So that really limits the types of assets you tend to find in REITs. The final thing that's really great about REITs is that for most of you, they're taxed at a favorable tax rate. Usually it's right a little bit below 20%. So if you're a high income household and your marginal tax rate, let's say it's 35% at federal, you might save quite a bit by paying 20% on the income from your REIT. So those are all really fantastic things. Bad things about REITs: not allowed to pass along any depreciation or tax write-offs. So all these great new things about the tax code, allowing aggressive depreciation to offset your income, none of that can be done in a REIT. Can be done in our structure. The other negative is that you have to buy really beautiful assets. So pros and cons to that. For us, we are technically a private equity fund. So for us, the money is tied up for 5 years or so. So we don't have the liquidity of a REIT. Most of the gains that we generate will be taxed as long-term capital gains, and you won't pay them until we sell something, which will be far off in the future. So that's very tax efficient. Our goal is not to generate any income or as little income as we possibly can. The income that we do generate from operations will be taxed as ordinary income in your case, just like your rental property would be the exact same tax handling. What's great about what we can do is we can pass along tax write-offs and depreciation, and we can buy properties that need work and have a big bump up in the value, or we can develop new properties. Very difficult to do that in a REIT, not really a very practical tax structure for that. For us, it's almost the ideal. So it really depends a lot on what you want. For many of you, the answer is probably both. You probably want to have a little bit of REIT exposure because it's stable, it returns less, but it's predictable and liquid. And some of us, higher returns, more volatility, harder to predict, tied up for a while, but our returns are a lot better. So thank you for asking. That's a great question.
That's what we have, Lon. We've got 3 more minutes. Are there any, we've got maybe 25, 30 more slides here. Do you want to address any specific ones here before we
Yeah,
end?
why don't we, I think you talked about the short-term income fund, so we can skip that. I think, why don't we just go to page 57? So we've been able to help out a lot of investors, and Justin, he wanted to generate a lot of passive income when he shifted from actively working to being retired. And he actually lives in Portugal now. And he was able to sell his small business, sell his real estate, invest a lot with us and in other things. And now he's living in Portugal, living his dream life, which is great. Next one for Jared. Like a lot of you on this call, he was next slide, please. He was an active investor with a number of rentals. Many of his tenants weren't really working out so well for him. He's been selling off his active rentals to invest with us, and he's getting good returns, and he's got a lot more free time for all of his other interests. So he's really happy with that. So if you go to page 60, I just want to kind of imagine, like, if you could get some of your time back, have more time to relax and enjoy quality time with the people who matter. If you can restructure your portfolio to get higher returns, so you can retire a little faster or retire with a little bit more and do it in a passive way, so you're not actively investing it, we can help you accomplish a lot of your goals. We won't be the only solution. Your financial team will help you figure out how much to put with us versus the other options that you have, but we'll certainly be one of the Lego blocks in the model that you build. So I'm going to skip ahead to page 64. Nick, you want to talk about what's an accredited investor?
Yeah, so to invest with Ironton Capital or any other company that is similar to ours, you need to qualify as an accredited investor in accordance with the guidelines by the Securities and Exchange Commission, which are listed on this slide. So you must have a single household income over 200,000 in 2 or more recent years, dual household income over 300, or you can meet the threshold via a net worth requirement of $1 million or more of investable assets, excluding the equity in your primary residence. You only have to meet one of these. You don't have to meet all 3. If you qualify via one of these bullet points, then you are an accredited investor and you get to invest in capital.
Fantastic. And why don't we just, I guess, briefly, you can use cash, your self-directed IRA. Yep. If you need help, if you've got a investment property with a lot of equity and you want to keep the property for some reason, I can introduce you to a bank that will give you a second mortgage on your investment property so you can cash out and redeploy it and invest it. And we can help you run through the math on if that's a good idea for you or not. And last but not least, if you go to the last page, we are very excited to meet with you to talk individually about your goals and do a portfolio review, and would love to help you out.